Calming influence out of the day's trade?
I mean, it was a dead day on the market, $3.8 billion worth being traded, and October was a quiet month, and the average value traded per day was $4.7 billion there. So really not too much happening in terms of the Australian market. And I guess what we have seen is less volatility in Australia compared to the US market this week. On the upside, we seem to be underperforming, and on the downside, we seem to be outperforming. And that's really what we saw with the Aussie share market, with a fall of 0.4% on our market, but a much worse performance on the US market. Once again, one eye on Europe and those borrowing costs, and we did see the cost of insuring French, Belgium as well as Spanish debt rising to the highest level post-Euro. So the market's keeping one eye on that, and of course Italy's 10-year bond yield is the big thing that markets are watching. Jumped 25 basis points overnight to 6.7%. We also saw that 5-year bond auction, the $3 billion auction, get away at 6.43%. So talk that the European Central Bank is still quite active, because we did see that bond auction getting away below market rates. We have a look at what happened domestically. We did see the RBA minutes out, no signs of a rate cut there, but altogether it was investors and traders really positioning themselves defensively. So those defensive areas outperforming. The healthcare sector, the telecom sector saw gains, and the worst areas were the property as well as the material sector. We saw Westfield taking quite a sharp fall, down by 2.4%, and BHP Billiton down by 1.7%.
Julia, I mean, any significance in the fact we broke below and stayed below 4,300? You've sort of been bouncing around that for a few sessions.
I think yesterday we mentioned that 43.65 was a high that we reached, and the last time we saw that was the other high point in November. So we matched that point, and we've taken a bit of a pullback. So technically, it does look like we've reached a bit of a ceiling on the Australian market. The US markets are looking quite similar, and I guess investors are taking quite a cautious stance on the market, given that the problems in Europe are still around, despite the change in leadership that we've seen in Greece as well as in Italy. So it does look like investors as well as traders still looking at capital preservation rather than making money in this type of environment, and unfortunately that's been a huge negative in terms of volumes on our market.
One update, cash profit up about 9.5%. It got sold down very heavily though.
We did see CBA down by 1.4%, but really what we've seen over the last 30 days is just consolidation around that $50 mark. So if we have a look at Commonwealth Bank shares, this is over the last 30 days, and this is what the share price looks like. You can see really it's just been some sideways movements, and we've seen that once again today. We did see the first quarter numbers out. They were slightly below expectations, but I guess the disappointing part was the stalling that we've seen in, and the falling that we've seen in the bad debt numbers really gave a kick up to that profit number, that cash profit number. So it does look like there's been a kick to the results because bad debts have been slowing down. The net interest margin has been falling, and it does look like the cost of funding still on the rise there for Commonwealth Bank. We have a look at individual sections. Trading income, well, we know volatility really isn't good for trading. In fact, we've seen Commonwealth Bank shutting its prop trading desk earlier this month. So we have seen trading income there down around about $60 million from the long-term average there. Also, if we have a look at funds under management, that was down by 3.7%, but it does look like house deposits are strong. And I guess the big thing for the banks is that we are in a very subdued credit growth environment. In this type of environment, it becomes a lot more important on what the big four banks are doing in terms of cost cutting. So the next 12 months, I think, is going to be a race to see who can cut the most amount of costs. And in that respect, I think National Australia Bank is in a very good place. So that would probably be my pick out of the big four. But Commonwealth Bank taking a step back today, down by 1.4%. But as you can see from the last 30 days, we've just seen consolidation around that $50 mark.
Julia, you answered my next question. It was going to be, what is your preferred bank from an investment perspective? But let's talk about NAB. What is it from NAB that sets it apart? A lot of people, and I know Michael there is a bit of a fan of ANZ, indeed many people are. What is it about NAB as opposed to the others that does pick your fancy?
If we have a look at ANZ and Commonwealth Bank, they are pursuing strategies offshore in the Asia region, and I guess that's a point of differentiation. But I guess there's a lot of costs involved in that. So if we have a look at the next 12 to 18 months, here domestically, what we are going to see still is probably continued subdued credit conditions, as well as maybe a tick up in that unemployment rate over the next 12 to 18 months. And that means that banks are going to have to be cutting away fat. That's not good news for for a bank like Westpac, which doesn't have a lot of fat to cut. It's probably the leanest and meanest out of the big four, whereas National Australia Bank does have a lot to cut. And in terms of share price action, I really look for catalysts to see which bank is going to outperform. In terms of possible catalysts, National Australia Bank has quite a few. If we do see a sale of the UK operations, that would be another kick up for the shares. So there are some potential upside catalysts for National Australia Bank. And I think it's good in terms of cost cutting that it has a lot to be able to do.
I might get